Okay, so let's try to unpack this. I want you to imagine something for a second. You're right on the edge of a huge, maybe even life-changing transaction.
Right.
You're closing on a house, or maybe you're a company buying another company, or, even just buying something valuable online from a complete stranger.
And you're ready to pay. You have the money.
Exactly. You're ready to hand over a massive amount of money, but there's a catch.
Mhm.
You'll only do it if and when you know for a fact the other side has done their part.
That the deed to the house is clean, that the software code is actually delivered, or that the antique is real and it's in the mail.
It's that fundamental friction point, isn't it? The trust gap.
It absolutely is. I mean, in an age of instant everything, we often can't do that simultaneous exchange. You can't just swap the cash and the keys at the same time if you're thousands of miles apart.
The digital handshake just doesn't cut it.
Not for high-stakes stuff, no. You need something more. A robust, legally binding mechanism that can act as a kind of temporary sanctuary for everything involved, just to make sure no one gets burned.
And that mechanism is exactly what we're going to be talking about today in our deep dive, escrow. It's this fundamental, but I think for a lot of people, kind of opaque financial engine that really provides the bedrock for trust in, well, almost every industry.
It really is. At its heart, escrow is it's a very specific contractual arrangement. It brings in a third person, a neutral third party.
The stakeholder.
The stakeholder or the escrow agent, yeah. And their only job, their sole function, is to receive and hold the money or the property or whatever the asset is.
And they can't do anything with it until certain conditions are met.
Exactly. The disbursement is completely dependent on meeting these very specific predetermined conditions that both sides agreed to at the very beginning.
That clarity is so important because it's not just a savings account. It's a commitment device.
Yes.
The agent's actions are dictated purely by that contract.
No discretion.
None. And I think, the origin of the word itself is such a great aha moment. It really helps cement the concept.
Yeah.
The word escrow comes from an old French word, escroue.
Yes, escroue, which it translates pretty simply to a scrap of paper or a scroll of parchment.
And when you think about why, it makes perfect sense. It refers to the physical deed, the scroll, the legal document that this neutral third party would physically hold on to.
So it wasn't even about the money originally.
Not at first, no. It was about safeguarding the legal proof, the proof that the conditions had been met before that final transfer could happen.
It just shows you the concept has always been about, neutral attestation and a conditional release. It's ancient, really, but its modern form, with all the technology and finance layered on top, is just essential for managing risk.
So that's our mission today. For you, the listener, we are going to move way beyond that typical image of a real estate closing, which is probably where you first heard the term.
We're going to show the incredible variety, the critical protective nature of this mechanism.
And really prove why escrow is the silent bedrock of trust everywhere, from finance to tech to law.
Yeah.
So let's dive into our first segment, the foundations of trust.
The agent's role is, in principle, very simple, but the execution has to be perfect. Their core function is just receiving and then dispersing funds or property, and only when those specific conditions are met.
So they're just waiting.
They're just waiting. They wait for either the deal to close, the consummation of the transaction, or for it to fall apart, the termination, which then dictates how everything gets returned.
This means that the agent, whether it's a big escrow company or just, say, a broker holding the earnest money for a house, they're operating under a very specific mandate.
Right. If they're holding a buyer's deposit on a business, they are holding those funds on behalf of a principal until that whole complex deal is legally finished.
And crucially, this agent has no discretion. They can't make a judgment call.
Not at all. They're not there to decide who's right or wrong or what's fair. They are purely contractual, conditional operators.
And that leads right to their biggest legal responsibility, doesn't it? Their strict duty.
It does. First and foremost, they have to properly account for every single penny of the funds in that escrow account.
This isn't just, close enough bookkeeping.
Oh, no. It's a non-negotiable legal duty. If a state-licensed agent misplaces funds or can't track them properly, the legal consequences are severe because they're managing money that isn't theirs.
And on top of that, they have to ensure that the money's used explicitly for the purpose that was laid out in the agreement.
That's the critical things you mentioned. If the money is earmarked to pay, say, a final property tax bill and some liens,
it can't be used to pay off the seller's credit card.
Exactly. The agent can't just redirect it. Their entire integrity, their entire legal standing relies on sticking to that purpose and only that purpose.
So when we think about where we see this, Real estate is obviously the big one in the U.S. Mortgages, taxes, all of that.
It's the anchor, for sure. But the sources make it clear that the mechanism is essential for securing pretty much any high-value asset transfer you can think of.
Right. I mean, things like buying a big revenue-generating website or the sale of an entire e-commerce business.
These aren't like selling a blender on eBay.
Not at all.
Yeah.
These deals involve verifying intellectual property, checking contracts. They can take weeks or months. And the whole time, that purchase money has to be sitting somewhere safe.
And what's really interesting is that the rise of low-cost online services has kind of democratized escrow.
It's not just for million-dollar deals anymore.
Exactly. Even smaller transactions like a person-to-person auction or buying a used piece of specialty equipment from someone across the country can now benefit. Escrow just removes that initial risk of who goes first.
It effectively lets you do business safely with strangers.
It does. You're both essentially saying, I trust this neutral third party to follow the contract more than I trust the person I'm dealing with right now.
And we see this same idea in other countries too. The
Yeah.
sources mentioned the UK, for example.
Right. In the UK, it's very common for solicitors or conveyancers to hold client money in a similar way. When you put down a deposit on a property,
That money doesn't go to the seller.
no, it goes into a protected client account. It's held there until the entire transaction is completed and the deeds are transferred.
It's ring-fenced.
Precisely. The rules are there to make sure that money is never, ever mixed with the law firm's own operating funds. It has to be available immediately, whether the deal succeeds or fails. It's a direct application of that core escrow duty.
We can make this even more concrete, I think, with some everyday examples like buying a used car from someone you found online.
That moment of payment is always the most awkward part.
It is. You want to check the car, check the title, and the seller, they want to be sure they're getting paid.
So you could agree on a temporary setup where the money goes into a specific bank account in the buyer's name.
And the funds are only released.
Once the buyer has seen the car, confirmed the title is clear, and officially says, yes, I accept it. In that moment, the bank account is acting as the escrow agent.
Another great one is a security deposit for a rental.
A perfect example. The landlord can't just pocket that money. Legally, it has to be held separately, often in a protected scheme or a special account.
It's only released after you move out.
Yeah, right. And only if the property is in good shape and you've met all the terms of the lease, the deposit is held conditionally.
And maybe the clearest example is in construction. If you're doing a big remodel on your house.
You never pay the full amount up front.
Never. The payment is tied to milestones.
Right. The contract will say that the total amount, maybe it's $50,000, will be released in stages.
So like 25% after the foundation is done.
Exactly. Then maybe 35% after the framing and the electrical work is finished. And the final 40% only happens when the whole job is certified as complete and it passes final inspection.
So the agent, or maybe a construction lender, makes sure the money only moves when those specific things are verifiably done.
It protects the homeowner from a contractor just taking the money and disappearing halfway through the job.
That distinction conditional payment based on agreed upon proof, that's the DNA of escrow. Okay, foundation is set. Let's move into the digital world because the internet was probably the biggest stress test this ancient idea ever faced.
Oh, absolutely. When things like online auctions and e-commerce really started to scale, there was a huge trust deficit.
You were sending money to a username, basically.
You were. And sellers were shipping expensive goods, just hoping the payment would actually show up. Internet escrow emerged as one of the most critical developments to bridge that trust gap.
It was the tech upgrade needed to make remote, high-volume commerce reliable.
The basic mechanism is simple. You place the money with an independent, and this is key, a licensed third party.
Once they confirm they have the funds, the seller gets the green light to ship.
Right. And when the buyer gets the item, they have a set inspection period.
And the money is only released when both sides agree that the deal is done.
When both parties verify completion. And this introduces a really important piece, a formal dispute resolution process.
Ah, for when things go wrong.
Exactly. If the buyer says the product is broken and the seller says it was perfect when it shipped, the money stays locked in escrow while both sides submit their evidence to the agent.
And the agent decides based on the original contract.
Right. The agent system determines if the money goes back to the buyer or gets released to the seller.
All of this speed and volume, it required a huge regulatory shift. Let's talk about that, starting in the U.S. with California.
This was a landmark moment. In 2001, the California Department of Business Oversight recognized how unique and risky these digital transfers were. So they created a specific license just for internet escrow companies.
Which gave them a layer of legitimacy, of government oversight.
It totally changed the game. It boosted consumer confidence enormously. And it wasn't just some small startup. The sources point out that escrow.com, which was founded by a massive company, Fidelity National Financial, became the first company licensed under this new framework.
It showed that serious financial players were backing this.
It did. And it's important for you to understand how this works in the U.S. There's no single federal license for online escrow. It's all done at the state level.
So California and Arizona are two of the big ones.
They're two of the most significant, yes. They have their own rigorous licensing programs that give these companies the legal authority to operate.
So, due diligence 101, if you're doing a big online deal, you should check that your escrow agent is licensed by one of these states.
Absolutely. Now, you can compare that to how the EU handled it. They used something called the Payment Services Directive, or PSD.
And the PSD was interesting because it sort of broadened the scope, right? It allowed for much lower cost services.
Exactly. Before the PSD, if a small business in Europe wanted that kind of security for a trade deal, they might have had to use a really expensive bank letter of credit.
A tool that's usually for huge corporations.
Right. The PSD framework allowed these web-based services to basically offer the same security as a letter of credit, but for a tiny fraction of the cost. It opened up global trade for so many small and medium-sized businesses.
A huge upgrade for digital trust.
But with the growth of legitimate services came the growth of sophisticated fraud. And we have to give a really critical warning here about bogus escrow methods.
This is where that verification becomes, life or death for your money.
It really is. Scammers have moved way beyond simple phishing emails. What they do now is suggest using a neutral third-party escrow service.
And they provide you the link to a convenient one.
Precisely. And the victim is tricked because the scammer has created an entire fake escrow site. And these sites are incredibly convincing. They copy the logos, the look, the feel, even the URL structure of a real licensed service.
So the victim sends their money, maybe tens of thousands of dollars for a car or a boat, to this fraudulent site, thinking it's safe.
And of course, the money is gone instantly. The victim never gets the product. They never get a refund.
Or the other way around, the seller sends the item after getting a fake payment received email.
And they wait for money that will never, ever be released.
So this is the key piece of advice we have to hammer home. How do you protect yourself?
You have to do your own independent verification before any money moves. A genuine licensed online escrow company will be listed on a government regulator's official website.
So you should never, ever click a link provided by the other person in the deal.
Never. You have to go find the state regulator's site yourself, like the California Department of Business Oversight, and search for the company's name. Confirm their license is active and all the details match. If you can't find them on an official government register, you have to assume it's a fraud and walk away.
That is a huge takeaway. Trust must be verifiable through an independent government source. Okay, let's pivot now from online shopping to physical machines, because escrow is hiding in plain sight.
It really is. The moment you walk up to an ATM, you're interacting with an escrow system.
How so?
Well, when you deposit cash, the machine doesn't just immediately dump it into the main vault and credit your account.
It holds it separately.
Exactly. It holds that deposited money in escrow. It's isolated. And that's crucial for fixing problems. If you think you deposited 20 bills, but the machine only counted 19.
The bank can check that separate, isolated stack of cash.
And if they confirm the error, they can return the money from that escrow hold without messing with the main vault.
It's all about maintaining integrity. A similar thing happens with a vending machine, right?
A textbook example of conditional release. When you put your coins in, they don't just fall into the main coin box.
They sit in that little window for a second.
They're held in a separate escrow area waiting for the transaction to complete. If the machine gives you your soda, then the coins drop into the vault. But if it jams or you hit the refund button,
they come right back out from that little holding area.
That temporary escrow hold. The principle is exactly the same, whether it's for 3 seconds in a vending machine or 3 years in a corporate merger. It's conditional release based on an outcome.
That's a perfect lead into our next segment, where we go from these quick transactions to the really big, high-stakes, long-term holds, intellectual property, M&A, and even gambling.
These are the applications that really show the flexibility of escrow in securing not just money, but information and complex long-term promises.
Let's start with intellectual property, specifically source code escrow. What is that?
Okay, so this is an arrangement where a software company and its customer agree that the source code for the software will be held by a neutral third party.
And why would a customer want that?
Business continuity. Think about it. You're a company, and you're dependent on a piece of software for your most critical operations. But you don't own the code, you just have a license to use it.
That's a huge
A
vulnerability.
massive one. What if the software company has a major service interruption or a catastrophic data loss? Or what if they just go bankrupt?
You're completely stranded.
Exactly. The escrow agreement fixes this. It says that if one of those triggering events happens, the supplier goes out of business, for example, the source code is released from escrow to you, the customer.
So it's an insurance policy. You get the blueprint for the software so you can maintain it or fix it yourself.
It allows your business to continue even if the original supplier is gone.
And this idea goes beyond just software code, right?
Oh, yeah. Information escrow agents hold all kinds of other proprietary assets. We're talking about detailed manufacturing designs, lab notebooks filled with research, song lyrics, even movie scripts.
Now, why would you put a movie script in escrow? It's not about business continuity.
No, this is purely about establishing legal ownership rights.
Huh?
The independent escrow agent acts as a formal witness. They can attest to three crucial things: who owns the information, what the information actually is, and the exact date and time it was deposited.
So it's like a legally recognized tamper-proof timestamp.
Precisely. That verifiable record from a neutral party is invaluable evidence in court if there's ever a dispute over who created the work first. It's a legal shield.
Okay, so from proactive legal shields to reactive legal settlements, judicial escrow.
Right. This is often used to manage the huge pots of money from court-ordered payouts. Think about a massive class action lawsuit with thousands of plaintiffs or a big environmental cleanup case.
The logistics of paying all those people must be a nightmare.
A total nightmare. So the mechanism is designed to handle that. The defendant pays the entire settlement amount into a single escrow fund that's administered by the court.
And by doing that, they wash their hands of the distribution process.
Exactly. Defendant's legal obligation is done. The escrow fund's administrator then takes over the headache of identifying all the claimants, processing their forms, and cutting thousands of individual checks.
And the fund pays for its own administrative costs out of the settlement money.
Usually, yes. It's a way to centralize the management of the payout under the direct supervision of the court.
Now let's get into the really complex stuff. Mergers and acquisitions. M&A escrow.
This is a whole different ballgame. It's so much more complex than a real estate deal because the things you're worried about aren't just physical assets, they're contingent liabilities, things that could go wrong years later.
So how does it work?
It's a risk management tool. When a business is sold, the seller makes a bunch of promises to the buyer. They're called warranties. Things like, our financial statements are accurate, or we have no hidden lawsuits.
But what if one of those promises turns out to be untrue, say 2 years after the deal closes?
Yeah.
The buyer discovers a huge, undisclosed tax problem from before the sale.
That's the exact vulnerability this is designed to fix. And it's especially important if the sellers are, say, private individuals who might not have the money to pay a claim years down the road.
So the buyer needs a guarantee.
Right. They'll require the seller to put a chunk of the purchase price, maybe 5 or 10%, into a dedicated M&A escrow account. That way, the buyer has a protected pot of money they can make a claim against if a breach of warranty occurs.
And this is very different from closing escrow. This is designed to last for a long time.
A very long time. M&A escrow arrangements are often set up to last for years, often matching the statute of limitations for whatever risk they're covering. The fund is there to cover future uncertain problems.
That long duration must create some serious complications, especially for the agent.
It does. This is where it gets really tricky. The M&A escrow agent might actually have to help decide if a buyer's claim is valid.
So they're not just waiting for a simple trigger anymore.
No. The buyer files a claim, the seller disputes it, and the agent is stuck in the middle trying to interpret complex contract language to see if the claim meets the requirements for a payout.
That sounds like a huge risk for the agent.
It's a massive risk. It's why the M&A escrow agreement itself is often as heavily negotiated as the main purchase agreement.
And because the money is held for so long, there must be other logistical things to worry about.
3 big ones. First, information. The agreement has to spell out exactly what reports the parties get and how often. Second, interest. What happens to the investment returns on that money over 5 years? Does it go to the buyer or the seller? That's a major negotiation point.
And the third?
the most important one, the creditworthiness of the bank holding the money.
What if the bank itself fails?
If the bank holding the funds goes under 3 years into a 5-year hold, the security that the buyer was counting on could be completely wiped out. So you have to do deep due diligence on the financial institution itself.
Wow. Okay, so from that complexity, let's go back to the simplest, purest form of all this. Gambling.
The historical root. The mechanism is just beautiful in its simplicity. Two people make a bet on a future event.
The outcome of a horse race? An election.
Exactly. They each hand over their money, their stakes, to a third, completely disinterested person, the stakeholder.
Who has no dog in the fight?
None. Their only job is to wait for the outcome. Once the winner is officially declared, the stakeholder distributes all the money to that person, based on the conditions they agreed to at the start.
It's the foundational concept.
It is, and it's why trustees who hold property for beneficiaries until they come of age are often seen as acting in that same kind of stakeholding role.
That universal idea of a conditional hold brings us right back to the most common place we all see it. Segment 4, the real estate deep dive and PITI.
Right, PITI. That acronym on your mortgage statement, it stands for principal, interest, tax, and insurance.
The P and the I, that's the easy part. That's your loan.
That's the money that pays down your balance and covers the cost of borrowing. The part we're focused on is the escrow payment, which is the amount you pay over and above the P&I.
And that extra money is for the T and the I, the tax and insurance.
Correct. So every month you pay that extra amount, and it gets funneled into a long-term escrow account managed by your lender. Then, when your property tax and homeowner's insurance bills are due, the lender pays them for you using the money from that account.
And why do they insist on doing this? Why can't I just pay my own bills?
It's all about risk mitigation for the lender. Remember, the house is their collateral for the loan. They can't risk you, the homeowner, failing to pay two critical bills.
Property taxes and hazard insurance.
Exactly. If you don't pay your property taxes, the county can put a lien on your house that gets paid before the mortgage lender if you're foreclosed on.
Which puts the lender's investment at risk.
Severely. And if you let your homeowner's insurance lapse and the house burns down, the collateral is literally gone. Worthless.
So by managing the escrow account, the lender guarantees those bills get paid on time, protecting their collateral.
And for some types of loans, like FHA loans, it's not even an option. The lender is required by law to maintain that escrow account for the entire life of the loan.
This brings us to a really important point for anyone with a fixed-rate mortgage. Your interest rate might be fixed, but your total monthly payment is not.
This is the source of so much confusion. People get a notice that their payment is going up and they get angry, thinking the bank is cheating them.
So why does the number keep moving?
Because your P&I is fixed, but the T&I, the escrow part, is dynamic. Property taxes go up, insurance premiums go up, and when they do, your monthly escrow payment has to increase to cover it.
Let's walk through the mechanics of an escrow shortage. That's the notice that always gives people a shock.
Okay, simple example. Let's say your annual insurance premium was $1,200. So your lender was collecting $100 a month from you for insurance.
Easy math.
Right. But then your insurance company raises your rate to $1,320 for the year. That's a $120 increase.
The lender has to pay that new higher bill.
They do. But they only budgeted $1,200 from you. So they've just paid out an extra $120 on your behalf. That creates a deficit, a shortage, in your account.
So they have to get that money back.
They do. So they adjust your payment in two ways. First, they need to start collecting $110 a month now to cover the new higher annual cost.
And second, they need to collect that $120 shortage they just covered.
And they'll usually spread that shortage over the next 12 months. So that's an extra $10 a month. Your total monthly escrow payment for insurance just jumped from $100 to $120, a 20% increase.
And that's why those annual notices can feel like such a financial hit.
And this whole process of recalculating is mandatory. It's called an escrow analysis. Federal rules under RESPA require the lender to recompute your payment at least once every 12 months. It's to make sure they're collecting the right amount and to prevent huge shortages or surpluses from building up.
And if there's a surplus, if they collected too much, they have to refund it to you.
They do if it's over a certain amount. It's an annual checkup designed to bring the account back into balance.
Now, quickly, we should just differentiate this long-term PITI escrow from the short-term kind used just for the closing of the sale.
Very different functions. The PITI escrow lasts for 30 years. The closing escrow might only last for 30 days.
During the closing, the escrow company is like the central hub for everything.
They hold the earnest money, the down payment, the loan funds, all the signed documents, everything.
And once they confirm all the conditions are met, title is clear, funds are in, papers are signed, they handle the final distribution.
They pay the seller, pay the title company, and most importantly, they record the new deed with the county, which legally completes the transfer of the property.
And again, we see courts sometimes acting in that exact same stakeholder role, holding property during a lawsuit until a judge decides who the rightful owner is.
It's the ultimate proof that a conditional hold is needed whenever an outcome is uncertain.
We've covered the whole spectrum, from ancient scrolls to the nitty-gritty of a modern M&A deal. Which brings us to our final and maybe most critical segment, the legal reality of escrow agents.
This is so important because understanding the agent's actual liability is key to understanding how much security you're really getting.
When you put your life savings into an escrow account, you naturally assume that agent is being held to the highest possible standard of care.
You assume they have a fiduciary duty, that they are legally required to act only and always in your best interest, like a trustee.
But that's not always the case.
No, and this is where the fine print can really shock you. The legal standard of duty for a contractual escrow agent can be surprisingly low.
How is that even possible? If the whole point is security, how can we accept an agent only being held to a gross negligence standard?
It is a profound vulnerability in the system. Many standard escrow agreements hold the agents only to that mere gross negligence standard.
Okay, so break that down. What's the difference between regular negligence and gross negligence?
It's a massive difference. Simple negligence is making a mistake, like failing to double-check a form. A fiduciary duty requires absolute vigilance. Gross negligence, however, requires an extreme, reckless, or willful disregard for the safety of the assets.
So a simple mistake is forgetting to lock the door. Gross negligence is forgetting to lock the door and also leaving the safe wide open with a sign on it that says free cash.
That's a perfect analogy. The bar is incredibly high for the person trying to prove it, and on top of that, these agreements usually have indemnity and hold harmless clauses that protect the agent from liability for simple errors.
So if an agent makes a costly but non-willful mistake, they might be legally shielded from having to pay for it.
In many cases, yes. The parties in the transaction are assuming most of the risk for anything less than a catastrophic, reckless error by the agent.
But there's a crucial exception to this low bar, and it goes back to what we said earlier about licensing.
The licensed versus unlicensed distinction.
Right.
Yes. If the escrow agent is licensed by a government authority, like those internet escrow companies in California or Arizona, then those government regulations impose much higher legal standards.
So the licensing itself brings a higher degree of accountability.
It does. It often pushes their duty much closer to that of a true fiduciary. It just reinforces how important it is to use the licensed agent. It's not just about avoiding fraud, it's about ensuring a higher standard of protection for your money.
So when we synthesize everything we've talked about, the main takeaway is that escrow is this indispensable tool for managing risk.
It is. But its entire integrity, its entire functionality hinges on the neutrality and the legal standard of that third-party stakeholder. If that integrity is compromised, the whole system fails.
We started this deep dive with a scrap of parchment, and we've ended up on the critical reality of the modern legal framework governing trillions of dollars.
A system built on contract law, but measured by the certainty it gives to commerce.
And with that, let's move into our outro. We've shown today how escrow really spans everything from ancient gambling stakes to modern ATMs, from protecting source code to funding huge legal settlements.
We covered how it underpins the sale of complex businesses, detailing that long-term risk management you see in M&A deals, and how it allows trust to work in online auctions as long as you verify that license.
And most practically, we demystified the one place you probably see it most often, your mortgage. We clarified PITI, the role of T&I, and the mechanics of that annual escrow analysis so you can understand why that payment can change and why that shortage letter shows up.
And understanding the legal realities that your agent might only be held to a gross negligence standard unless they're government licensed, that's probably the most essential piece of knowledge for deciding who to trust with your assets.
Which leads us to our final thought for you to think about. We've defined escrow as isolating funds for a specific purpose. And at a larger scale, that idea is very similar to ring fencing or stewardship in corporate governance.
Right. So given that so much of global commerce, especially in these huge long-term deals, relies so heavily on the ethical behavior of these third parties, even when they're legally protected by that very high bar of gross negligence.
We have to ask, how secure is the system, really? How reliant are we on the basic integrity of a small group of specialized companies whose primary legal duty is often just not to be extremely reckless?
It raises that final question. As assets get faster and more digital, how do we make sure that the age-old integrity of the person holding the parchment scroll remains strong enough to sustain our fundamental trust in the system?
Something to consider next time you put some cash in an ATM.